The markets are wild right now, with volatility shooting up, especially in the crypto and tech sectors. The VIX, often called the fear gauge, has been on the rise, signaling growing uncertainty among investors. These big price swings can create both risks and opportunities. So today I'm going to dive into what is driving the turbulence and strategies that I'm using to navigate this. Hi, this is Looney, and I have open a article that goes over that, along with 4 other articles that I will leave the link in the description about volatility in the entire market. But today is August 30th. It is currently market hours, so my count is up on the day, 22.3K. And I'm going to go over 3 strategies that are easy to learn and very good to use when the market is volatile. I'm going to use stocks that are easy to understand because of the pricing of them. And let's get into this. So the first stock I'm going to use is HUT. I'll be using HUT throughout the video. And the first strategy I'm going to use is a cash secured put. And the way a cash secured put, it's a consistent strategy, and you can learn about it here actually on Robinhood. And it's one of the options here, cash secured put, and you hit the question mark, and it goes into detail what a cash secured put, but basically it's a selling option contract that is consistent, easy to learn, and the way it works is you either own the shares or you collect the premium and you keep running the strategy depending on where the stock falls at expiration. So how do we get into this? So what you're going to want to do is find the stock. I like HUT because it's easy to read, $10, and you hit trade options, and up here is important. This is the expiration date. One of the best is 1 to 6 weeks is what I like to trade, and you could do whatever. 1 to 6 weeks is good because depending on how much you want to manage this position, if you want to look at on the daily, you can do 1 week and do shorter expiration, or do longer and do about a year. I think 30 days is a good sweet spot where you get that good risk and return. And we're going to choose the September 27th. And we're going to click sell put. So that's important. And we're going to look at this bar in the middle where it shows the current share price. And anything above that share price for puts, this is for puts only, is in the money. Anything below that bar is out of the money. And that's important because when selling options or selling puts, you want to be out of the money. And that's below this bar. And the reason for that is because you might end up owning the stock at their strike. And the strike price are these numbers on the side. So there's $10 put, 9.5, $9 put. I'm just going to choose a $9 put and I'll show you why. So one is delta. Delta is very important. It goes over the chance that the stock will be in the money. And it goes hand in hand with chance of profit. That's why I have these two together. So there's about a 26% chance that it will go into the money, or that I'll lose this trade, or that I'll own the stock at $9. And then there's about a 30% chance that I don't have profit. And this delta is very important. I like to do 20 to 30. You can go into why and do your own research, but it's one of the best for risk versus return kind of reasoning. So we're simply going to choose this $9 put, and I'll show you how it works. So what's important is this max loss. Right now it shows 860, and the way this works is this 860 is the cash required that you need to put up for this trade. And how you get 860 is, it's pretty simple. It shows you here. So it's this $9 strike minus the premium, which you'll be getting paid. So it's $9 minus 40, and you get 8.6. Or the break even, also right there. And you times by 100 because contracts are 100, you get 860 max loss. and which seems scary because the max profit is small and the max loss is a lot, but you only lose 860 if the stock falls to zero. You don't actually, the chance of it falling to zero is pretty much impossible. I don't want to say it's not possible, but it doesn't really happen ever. So that's important. They just need to make sure that you actually own the money. So when you go here, they'll say deposit the funds, or if you have buying power, it'll let you do that. And this is a great trade to open. And if the stock stays above $9 at expiration or until expiration, you will earn $40, or you'll realize the gain of $40. And you could keep running this strategy. So if the stock falls below $9, you can also earn a profit, but you're required to own the shares. So you're required to own the shares at $9 no matter what the stock is if it falls below. So if it falls below $9, you're required to own the shares at $9. You can still earn a profit, but it is a requirement. So when you actually own the shares, it might seem like you're at a loss, but if you look here, because you got paid that premium, you actually can earn a profit. Now, let's say it goes below the break even, 8.6, you do earn a loss, but you do also own the shares. So you can keep running this strategy with a covered call that works very similar. And if you stick long enough, I might get into that. So that's really it for cash secured put. As you guys can see, it is very easy to understand, and it's consistent. Selling options are very consistent. And I'm running this strategy on a bunch of other stocks. I'll show you, I have them open. And some are long-term, some are short-term. This one is actually a failed one, or it's one that's going to be earning me a loss, but I'll own the shares at $8 up there, and I could run covered calls, which I am doing on these other stocks or positions. So the second strategy I would like to go over is a long-term call option or a leap. I'm going to use the same stock, HUT. It's a crypto mining company, and we're going to do the same kind of technical analysis. This time, we're going to look at the Bollinger Up, or U. So Bollinger U says 18.27. So there is, or even we could look at the break even or the moving average. So the moving average has it at 11.77 and the upper is 18.27. Also, RSI is in the middle right now, so it's perfectly priced. So how do we open this trade? So you're going to go to trade options, and you can read about it here again. It's called long call. Hit this question mark, and it goes in detail how it works. And it is a bullish strategy. And all these are bullish strategies I will be going over because I feel, or history says that the market tends to go up long term. So we're going to choose an expiration that is far, anything that is over a year. I'm going to go the furthest, so January 6th, 2026. So calls work slightly different with the bar. So that bar in the middle is the share price. And this is the opposite of puts. So anything above that bar is considered out of the money. And anything below that bar is considered in the money. When buying calls or long-term calls or leaps, you want to be buying in the money options. And the reason is because you're looking to have this stock rise and eventually go out of the money. And once again, the two things I'm looking at is chance of profit and delta. So the chance of profit is all low on these. And that's because it's uncertain, because it's almost a year, further than a year. So it's very uncertain whether the stock is going to go up or down. And if we look at history, stocks go up in the long term. So it is not truly accurate with the chance of profit. What is more important is the delta. I like to choose a delta of 8 or 7.7 to 0.9. Anywhere in between that is the sweet spot. And I'm going to choose this 0.8 delta, this $8, Or I might change it. We'll take a look at what I would like to do. Let's do this 0.89 call. So perfect. It's this break even that we're going to be looking at. So what you might be wondering now is, why don't you just buy the shares now, and then when it goes up to 13, you will have a profit about 300. And that is a very good point. The thing is the better thing to do with buying calls is that it's cheaper. So you could buy 100 shares right now for $10, and that will be $1,000. Or you could just open a contract and you're only spending $8.45 to own these shares in the future. That's important. Okay. Let's get into how this works. So the way it works is the amount you're going to be paid. You're going to be paying the premium on this side. When selling, you earn the premium. When buying, you pay for the premium. So the price you're going to be paid is this $5 plus the premium, which is $8.15. And then, right? Hold up. I'm sorry. Yeah, you're going to just be paying the premium is what I meant to say. All right, to continue, you're just going to be paying that $800 premium. What I meant to say is the profit, how you understand how the profit works. So the way the profit's going to work is that you take the price at expiration, whatever it is, so let's say it goes to 13, and then you minus the strike, 5, so 500, and you minus the premium. And that's how you get there. So the break even is showing here at $12.45. So anything above $12.45, you will earn a profit. Anything below, you will earn a net loss. And in my opinion, I believe that HUT will be well above $12 in over a year. I think it should go up to around 15. It should sit at, and you'll earn $300, which is a really good return on investment. So this is another good strategy to use for long-term bullish. And it's cheaper than actually outright buying the shares now. All right. So the third strategy I'm going to get into is a little bit more confusing. It's a a covered call strategy. And the reason I chose this one last is because you can actually own shares when selling puts and buying a call. So if the stock trades below your, or if the stock trades above your break even or strike, you actually own the shares at the strike. So $5, you'll own the shares, which will look good on paper, but you also paid for the premium. So that's why the actual net profit is at $12. And with covered call, it's a strategy that you need to own the shares. You need to own $100 or 100 shares of the stock. And you can do that either by buying a long-term call and then owning them at expiration, or selling a put and then owning them at expiration. And I'm going to show you how to sell a cash secured put. And it works very similar to the selling put side. And you're going to simply click sell call. Before I get into that, I'm just going to show you that, again, you can read up on it here. And it works very similar to selling a put. It's a bullish strategy. You collect premium. And I'm going to do the same way I did selling a put. I'm going to choose 30 days out. Same idea. You could choose 1 week. You could choose 10 weeks. It's really up to you. There's no better strategy. As long as it fits the criteria of the delta, chance of profit, the Bollinger Bands, and any other technical analysis that you're looking to look at. So what I'm looking at here again with selling calls is very similar. A 0.25 to 0.35 is what I'm looking for. I look a little bit more for the delta. I look for a little bit higher. And if you look at this bar again, just like we said for buying calls, anything below is in the money and anything above is out of the money. When you sell calls, you want to be out of the money. I'm going to use a different stock. No, I'm not. Let me see. Because it's looking a little weird right now. Yeah, we're going to choose a different stock because there's not much interest or open interest or a lot of people trading it. So we're going to choose Riot. It's going to work the same way. And I do this trade. So we're going to choose September 27th and sell call. And like I said, anything above the bar is out of the money. Anything below the bar is in the money with calls only. And what I look for is a delta of 0.25 to 0.35. So right here is this $8.5 call. And you simply click on it and hit sell. And we're going to get into this. So this is a little bit more advanced. The way it says on paper is that if the stock rises above this price, you will net a loss. And this is actually untrue. You won't lose money if the stock is above the break even. But you will lose the opportunity to gain money. So you'll be required to sell the shares. So what the way it works is anything above 8.5, you're required to sell the shares at 8.5. Anything above 8.88, it says you will have a net loss, but that's not true. You'll just lose out on the opportunity. Because let's say you didn't have this contract open, you just had 100 shares, you would be able to sell the stock whenever you'd like. You could sell it up to here, you could sell it up to any price and earn that money. So that's why it's saying that you'll net loss, but it's not really net loss. It's just simply saying you lose the opportunity to gain anything. And this is showing a naked call, but a covered call, you own the shares. And the way it works is, like I said before, you can earn profit as long as the stock stays below this strike price, 8.5. And you could also earn profit as long as it stays above the break even, which is just the strike plus the premium you're getting paid. You're getting paid premium when you sell contracts. And the issue is you have to sell the shares anything above 8.5. And there's a way to get out of this scenario. And what I like to do, and I go over this in a lot of my other videos, is rolling. So you would roll the strike or strike up and out. I would look at another one of my videos because that's going to take a while to explain that. Or you could buy to close. And you'll see when I hit review, it will say I don't have enough shares. So you need to own the shares. And there's multiple ways to get into the shares. To get 100 shares, you can sell a cash secured put. You can buy a long call. Or you could just buy the shares outright. I like doing cash secured puts because it's cheaper. And I hope you guys enjoyed this video. If at any point was confused, you can reach out to me on Twitter, join my Discord. Links will be in the description. Like, subscribe, and have a good one. Peace.